They will destroy everything. I'm your host, Steve Van Metre, and thanks for joining me today. In today's show, I want you to see how political elites are planning to destroy the global economy in their effort to bring inflation down, and yes, the same inflation they helped create during the pandemic. And they're warning consumers all over the world that inflation will destroy their way of life, and their only salvation, their only hope now is to trust central bankers who seem to be the only people who can bring inflation down. But as you'll see in today's show, these central bankers and political elites are absolutely clueless how the global economy works. They don't understand inflation, and with their heavy-handed monetary policy, they're going to have a bigger problem when they crash the global economy and we face deflation. Let's over to Bloomberg, where we can start the story out, where I want you to see just how clueless these political elites are. Summers warns of 1970s crisis if central banks relent on rates. And here you can see just from the headline alone, we need higher interest rates. This is the problem. It's going to bring inflation down. Is the only solution is just more and more rate hikes. Going soft on inflation will plunge economies back into the recessionary depths of the 1970s and have adverse effects on working people everywhere. Former U.S. Treasury Secretary Larry Summers warned. And again, we look back and they're pointing to the fact that we are in the 1970s. And granted, we were in the infancy of the global reserve currency, with the dollar being the head of it. Now you start to think about this, and we now fast forward to where we are in a global economy. We really weren't there in the 70s or even we're close. We were just in the beginning of trying to figure out how the dollar is going to function as a global reserve currency. And yet now central bankers are saying, because they only look at their textbooks and charts and data, that this has to be like the 1970s. And boy, what did we make the big mistake then? We didn't hike enough. We didn't drive rates higher. And yet what did we find out happened then? Well, of course, we had a whole bunch of recessions. To suppose that some kind of relenting on an inflation target will be a salvation, that would be a costly error. It would ultimately have adverse effects as it did in a spectacular way during the 1970s. And what Summers is referring to, and I'll show you in a chart here in a bit, is the Fed backed off on inflation. And since it lowered rates, inflation came back. The Fed had to hike again, and then it pulled rates down. Then inflation took off again. And that's what they think now. They believe inflation is highly embedded in the economy and can now only go up. The only solution, of course, is we should look to them, the experts on inflation, the experts on the global monetary system, and trust them with our future. But of course, we know better. That's not what's going to happen. And he said this at a recent World Economic Forum meeting out in Davos. And here we can see what he's referring to as we look at the consumer price index and going back to the 70s. And what you can see is that central bankers feel like we're right about here at 1970, where we saw kind of a spike in inflation. And you notice we didn't really have that until the pandemic. And what they're afraid of, what they believe is going to happen, is that inflation is going to cool off a bit and then spike higher. And inflation is going to cool off a bit and then spike higher, and that's going to be the problem that they believe is happening. But yet when we look to the bond market, and this is really key, because the question we should be asking here is the tail wagging the dog, or is the dog wagging the tail? And that is when I'm referring to central bankers. Are they the ones that are always behind the curve and clueless, or are they the ones that are driving the sled here? But in reality, what we know is the Fed and central bankers are darn near clueless. It's the bond market and other data indicators that are telling us what the real story here is. So when we take this chart here as a 10-year Treasury constant maturity, subtract the 2-year constant maturity yield. Now, those of you who regularly watch the show, we like to use the 3-month Treasury yield, but there wasn't as much data. So we're going to go to the 2-year, which gives us the same information, just in a slightly different way. And I've noted this yellow line here that I crudely drawn in across the horizon is where the red line, the yield curve, is inverted. And what we can note, and we can just go back because we don't have a ton of data here, but we can see where the curve had steepened, and that marked a bottom of inflation, at least back near the mid-70s, before it spiked higher as the curve came down. The inversion of the curve signaled the peak of inflation, or the near-term peak, and we see that again going into 1990. The curve inverted, inflation would later peak. We see that in 2000, where the curve inverted, inflation would then later peak. We see that going into the great financial crisis. Again, the curve slightly inverts. Inflation due to oil goes higher, and then it starts to come down. And here we can see a marked inversion here, the largest inversion since 1980 in the 10-2s curve. And what is that telling us is we don't need higher rates. It's not a function of rates. The bond market is telling us that growth and inflation expectations are indeed coming down. It's not a function of what the Fed's doing. It's the fact that the global economy is slowing. Now, it doesn't take a PhD in economics to figure out that perhaps the real reason the economy has experienced inflation was because we shut the entire global economy down, and then we pumped people's pockets full of money. They went out and spent it. It cleared off the shelves. And the global economy is slowly playing catch up and still reopening to this day to deal with that massive supply shock. Now, at some point, the shock goes away along with all that fiscal stimulus, which is now gone. And here we can start to see the real issue here of what was driving inflation back in the 70s. And for this, we had to go to the spot crude oil price for West Texas Intermediate in the St. Louis Fed database. And what we can see is it perhaps had nothing to do with interest rates. It had to do with energy. And we can note that inflation spiked here in the early 70s as crude oil prices went up. It happened again in late 1970s. Again, this wasn't a monetary issue. This wasn't because the Fed relented, because the correlation between crude oil prices and the federal funds rate is about zero. And I'll challenge you to see if you can find it, but there's no relationship between the two. The notion that the price of oil has something to do with the target federal funds rate is preposterous. And now when we go back and look at this chart, what we can see is that crude oil is running a year-over-year rate of change of 0%, which is consistent with inflation coming down. In fact, when we look throughout history, you don't see periods of high inflation. We tend to see around a 2.5% level. And if you recall, the Fed's target, well, that's 2%. Inflation peaked in double digits across much of the industrialized world, but is expected to drop rapidly this year on the back of falling energy and commodity prices. Finally, something the media gets right here. However, core inflation will remain elevated as wage behavior and companies' price setting has fundamentally changed. This not from the media, at least their reporting of it, but from the Swiss National Bank chairman. And here's what they've got wrong. Wage growth doesn't actually mean a whole lot here, because you can have wage price spiral, which is what central bankers are afraid of. But when you start to slow the economy down, what starts to happen next? Demand falls. And what do companies eventually do? Well, they lay people off. And do you know what happens to people who are laid off in terms of their consumption of energy and goods and services? Well, it drops significantly. And that's what the central bankers can't see, is they're driving the economy into a recession. It's already slowing now, but they're doing it through these heavy-handed monetary policy. Because when you think about a debt-based economy, what do you need it to do? Create more debt. And there's two ways you can do that. One, you can drive rates down until people choose to borrow money and consume, or you can get the economy running really hot and rates will actually go up during that point as the demand for money increases. This has nothing to do with the Fed in this case. It's just looking at the economy. The economy for decades has been weak, not reflected in the stock market, but overall weak because interest rates have been falling. And so we start to get this perspective that these central bankers know nothing. The counterfactual is not, can we have more inflation and no recession? It is if we fail to deal with inflation, we are likely to have a more severe recession at some point. Central bank chiefs on the panel all agreed that tighter monetary policy was needed to bear down on inflation, which was still close to 10% in the US, the Eurozone, and the UK. And of course, now you start to see that we're using this lagging indicator of the consumer price index, which is by and large lagged by almost 6 months because it is difficult to calculate. The data points are smoothed out, and it just is historically a lagging indicator. But what do we look at? We can have more inflation and no recession. If we fail to deal with it, we're going to have a more severe recession. Well, here's the news, central bankers. We're going to have a recession anyways. The yield curves are telling us it's going to happen. It's not telling us exactly when, it's telling us it's coming. The notion that if we don't contain inflation will be worse, well, the data actually shows if we have recession, inflation comes down. And here we can see the yield curve predicting accurately when we see the 10-year, 3-month yield curve. It's predicting not with the timing aspect, but leading indicator that a recession is coming. You can see the inversions under the black line predict accurately we're facing a recession. And based on the available history in the St. Louis Fed database, we have the largest inversion of the 10s, 3s in history, suggesting that we are indeed headed to a recession. But the cluelessness doesn't stop here. Let me show you some more. Global inflation scare vexes central banks as they seem perplexed, even as the shock fades. Amid a collective sigh of relief among the business and political elite in Davos, monetary officials there and elsewhere caution the falling headline consumer price gauges might yet prove to be false dawn. And here's the point I want to make, is they are so convinced that they are right here. They're so convinced that inflation is going to just pull back and then shoot higher that they're going to continue to restrict monetary policy until they drive us into a massive global recession. We will see deflation, and then of course you know what they're going to do. They're going to cut rates and say, well, wait a minute, we didn't see this. The data said that we were having a big problem, and our historical model said that inflation was going to run out of control, but we know that's not the case. This is an issue. Isn't that the fact that money was printed or inflation was created? It was due to the supply shock of the pandemic, and that is what we're seeing ease. Stay the course is my mantra, European Central Bank President Christine Lagarde told the World Economic Forum on Friday, while her Swiss counterpart Thomas Jordan said we should not underestimate the second round effects that are already underway. Over in the U.S., Federal Reserve Vice Chair Lael Brainerd reminded investors that inflation remains high and policy will need to be sufficiently restrictive for some time. Monetary policy, she said, still has more work to do until the actual economy continues to slow. And what we will see, of course, a question I mentioned earlier, is the tail wagging the dog or is the dog wagging the tail? Well, the answer is, in this case, the Fed is the one that's being wagged. And here you can see inflation takes off, the Fed plays chase higher, and then you note in the 70s they started cutting rates and inflation came down before, of course, the question now being which is causing what? We see inflation then go back up due to oil prices. The Fed then drives rates higher again and then brings them down, leading inflation lower. Again, the question here is who is really driving this bus here? And it appears not to be the Fed. The Fed tends to cut before inflation peaks almost every time. And so what we can see here is the probabilities the Fed is going to pause and cut rates in the future, especially this year, is not going to be because inflation comes down. They're going to do it because the economy is going to slow. Now, what we don't know is if over the next few months the economy bottoms out and starts to recover, if there's enough consumer demand, or if we're more in the eye of a storm here, and then into the middle part of the year, we see another big round of layoffs come as companies then say, hey, you know what? Demand didn't come back, so we have to get rid of people. We just don't know yet, but I want you to see that what's going on with these policymakers and how they've got it wrong. Because inflation is largely a function of energy, as we've addressed in the show many times. Here in this chart, the consumer price index against U.S. regular all formulations gas prices, both on a year-over-year rate of change, suggesting, just as the WTI chart show, that inflation is likely headed back to 2.5%, regardless if the policymakers increase or decrease rates. We are already set on the path for this. The problem is the economic data is indeed lagged and it is slow. The economy is a big moving machine and it doesn't slow down and shift down rapidly. And so what you have this case of, central bankers restrict credit in a debt-based economy, and it leads to a further slowing. And next thing you know, they're playing catch up. Again, they're the ones being wagged. In this case, but they also see that there's problems in China, and I don't get it, but they're telling us that China's going to lead to inflation? I don't think so. Lagarde says China's economic rebound revives inflation worries. Get this, China's abandonment of its COVID-0 policies is good news for global economic growth. And it is because, of course, they will drive consumption. And it could give a fresh boost to inflation in Europe. European Central Bank Christine Lagarde said the change of this COVID policy will revive the economy and is positive for the world, but there will be more inflationary pressure. Now get this, China actually exports deflation. When the global economy is functioning in normal ways, they export deflation because they're the low-cost provider of goods to the world. And here you've seen, and again, I just want you to understand how clueless these policymakers are, because they're absolutely intent on raising rates and continuing to do so as the economy slows, because they just don't get it. The ECB president said a faster growing Chinese economy would boost global demand for liquefied natural gas, oil, and other commodities, potentially pushing prices higher, and yet they can't see what the truth is here. Inflation seems to have started heading the right direction, according to the head of the International Monetary Fund. We don't know quite yet how inflation would march downward, Georgieva said. What is the good news of China growing faster translates into oil and gas prices jumping up, putting pressure on inflation. And of course, they've got it wrong, because where's China going to get all its oil from? We talked about this on the show the other day. In fact, I believe it was yesterday. They're going to go to Russia and buy it on the cheap. And that is why we know that actual China reopening is actually deflationary for the economy. But as you can see, central bankers, they continue to strike out and get it wrong as they drive the global economy into a recession. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.